I'll be happy to see your faces. Thank you very much. And we'll delve swiftly because we know it's a busy day and we all have schedules ahead of us. So we'll take the opening remarks from the Managing Director, American Wealth Management Limited, Taiwo Yusuf, as we kickstart this morning. Round of applause for him, please.
Thank you, Babatunde. Thanks everyone and good morning. Very bright day and a morning as well. And it's our pleasure to welcome you to this event today. Good morning, distinguished guests, partners and friends of Meristem. Those here physically and those online as well, we welcome you. It's an honor to welcome you to this summit, which we have termed Meristem Commodities Summit. We gather here at a time when commodity prices are moving faster than many of us can plan for, whether at individual level, corporate or national level. From the food on our table to the energy that powers our factories, volatility in the commodities market is no longer a distant concern. It is shaping the daily reality of manufacturers, business leaders, and investors across Nigeria. Margins are tighter, planning cycles are shorter, and the cost of being unprepared has never been higher. And yet, within that volatility lies opportunity for those who are informed, who manage risk deliberately, and who plan ahead with the right insights and the right partners like Meristem. That is precisely why we are here today. This summit is built around three things. We structure this session into three parts. The first part is a presentation. And the presentation, our team will be sharing their view on the market performance and outlook for the agricultural commodities throughout the rest of the season, giving you a very clear insight of what to plan for and what to plan against. Secondly, there will be a fireside chat and panel session where we bring together industry experts, and you've seen in our flyers the names and the profiles of the people which we'll also be reading out to you later in the day. Business leaders to speak candidly about how they are managing uncertainty and what lies ahead. And the third part of this session today, which we are all very proud of, and which the earlier mentioned, is the official launch of Meristem Commodities Fund. This is our maiden fund in the commodities space, and this fund represents our conviction that the commodities market, if properly understood and professionally managed, can be a source of resilience and growth rather than risk. It is our way of turning the insights that we've built over the years into a vehicle that we call investors to invest in and partake in the opportunities that lies in the agricultural commodity space. To our speakers and partners, thank you for lending your time and expertise. To everyone in this room and online, thank you for choosing to spend this part of the day with us. Our hope is that you leave here better informed and better prepared. Welcome once again to this summit. Thank you.
Thank you very much, Taiwo. You would see the demure in the way he's presented his speech. He was not as loud as upcoming artists like me. You know, we have a bit of professionals in the house who would be speaking at the panel, and I thought it was best to introduce them as already highlighted by Taiwo. So in our midst this morning, we would have Afolabi Akinrogunde, the head commercial growth and partnership Shell Energy. A round of applause for Mr. Afolabi. We also have with us Evans Obayayi, supply chain manager Nestle. Round of applause. We have Abhinav, commercial business head Soya Crush, Olam Agric. Round of applause for Abhinav. Olaoluwa Bamigbaye, PhD, founder cares and Herald Agro Ally Limited. Round of applause for him. And last but not the least, on the table, we'll be having Mide Pokwola, the General Manager, Commercial Decentralized Energy. Round of applause for them. I'll have introduced myself too, but it's not my space. So let me just stay in my own line. So as already highlighted, we'll be having insight discussions, which sort of gives people in this room and online better understanding of what the commodity space is talking about. We'll also dive into discussants with the professionals I had mentioned earlier, who would be highlighting several opinions from our mind. Questions can start rolling online. And for some of us in the room, we can also pen down some things we would like people to shed lights on. And to take us on the research presentation is the head commodities solution Meristem Wealth Management Limited, Yusuf Okunbi, the man who I'm sure has burnt a lot of midnight candles just to make today a success. Ladies and gentlemen, Yusuf.
Good morning, everyone. Thank you for joining us today. Usually, we held this session last year, and we saw the impact it had in the engagement we had with clients, with investors, and we thought it's just helpful to have it as a yearly event to communicate and engage people here and there about what is happening in the market. That was the intention at that time. But since then, I think we've seen way many more reasons to actually continue doing this. On the 28th of February 2026, we saw another geopolitical event play out in the Middle East, and that has actually changed all the plans, budgeting sessions, retreats, all calculations you could have done December last year. It has actually upended almost all of it. And before then, we were doing PMS at roughly about 800 for those of us up north. And then now we are doing 1365, 1364 in some places. But that's in Abuja where I stay. You could go as high as 15 in some parts of Jigawa that I'm aware of. You can go way higher than that in some further interlands in the country, which tells us that volatility has become the norm. We usually say it as we are in a VUCA world, volatile, uncertain, complex, ambiguous world. But that has actually become the normal environment. So we're in a new normal, so to say. So today we'll be discussing outlook, majorly looking at what the prices have done, what has happened year to date. And then we'll be discussing outlook for the rest of the year. Very importantly, mentioning a thing or two about the planting that we are seeing, the progress in the planting season that we are all experiencing. Nigeria is a rain dependent country when it comes to planting. So the moment we see the rains, we know that the planting season has started. When we don't see the rains, we should begin to get hints here and there about what is going to happen. So now, just to dive into it. So we call our desk the Commodity Solutions Desk, not the Commodities Trading Desk. Emphasis on solutions because we think that there is a lot more options to provide solutions to clients than just trading. And that's what we intend to achieve. Next slide, please. So next slide, we'll come back to this. So Nigeria has gone through a massive correction cycle, Inflation has gone from in the 30s to somewhere in the 15s as we have it today, mid-teens as we have it today. And what that has done is that commodity prices have corrected heavily. Maize, soybeans, sorghum, they've all corrected heavily from the multi-year highs that we had in 2024 post subsidy removal, post exchange rate alignment. We had that adjustment going into 2025, and we've seen the impact of that following the monetary policy environment that we have in the country, and prices have corrected as such. So if you look, next slide, please. If you look at what we've had in the country, you've come down from the highs of 17 thereabout to about 1,360. The exchange rate has more or less remained range bound between 1330, 1380, 1390. In some cases, it has touched 1400, but it has always retreated from that particular level to about, and it's currently at 1360. Reserves are at multi-year high. Go back to that slide. Please stay on that slide a minute. Reserves are at multi-year highs at 49, almost 50 billion, 50 billion USD. Pardon me. MPR is currently at 26.5. Given the last MPC meeting, we saw the MPC maintain the rates. All indicators maintained because of the current environment we are in. Initially, at the beginning of the year, there were emphasis of probably 2 rate cuts, as our research team has indicated in some instances. But then, following the geopolitical events we saw in February, the MPC has been forced to maintain a hold stance, more or less, to say, see, at this point, we don't know what is happening, what may happen, basically. We would rather maintain a hold, prevent a dovish or more or less going to a hawkish environment, but maintain a hold. But one thing that we've seen differently since that time is that inflation has gone up from about 12.12 in February to about 15.69 now. And if you look at the driver of that inflation, it's majorly food and energy prices. And that's a consequence of what we've seen since February. Now, what we are saying is Nigeria has gone from the volatile, extremely volatile environment into a range-bound environment, but that range-bound environment still poses some elements of volatility. That's one. Two, Nigeria is not an isolated economy. We're in a global economy as it stands. So anything that happens in the global economy would naturally affect us, whether it's on the energy side, whether it's on the food side, whether it's on the weather side, it will naturally affect us, and we are seeing effects of that. Now, next slide, please. Now, if you look at these prices, let me stay on this side so everybody can see. So you're looking at soybeans. Why do we have soybeans, maize, and sorghum here? It's because combined between these three commodities, you are looking at roughly 90 million metric tons consumption in the country. 6 million for sorghum, 12 million thereabouts for maize, and about 1 million metric tons for soybeans. So you are looking at sizable consumption in the country, and all households, one way or the other, directly or indirectly, we are consuming these items. So if you look at your breakfast meal, if you are consuming what is it called? Cornflakes, you are consuming maize. On the back of that, if you go for lunch and then you have rice and chicken, you are consuming maize and soybean in your chicken. If you consume some element of any beverage, whether it's a whatever form of beverage, you are consuming some element of sorghum in that. So it's ingrained in our everyday lives. So looking at these prices, we saw the massive correction in maize and sorghum prices. Some may call it a crash, but we saw these prices correct heavily. And we are currently, if you look at it, we are currently at post somewhere around 23 before the subsidy removal levels. If you look at soybeans as well, probably above those levels, but we've seen massive correction from about 1.2 million naira per metric ton to currently about 780, 790,000 naira per metric ton, depending on where you are looking at. So you are looking at an environment where correction has been significant. But what it means is that inventory holders are now being penalized for holding inventory. Companies cannot plan for long, so you can't just buy inventory now and expect that you use it for 6 months. There's a likelihood that prices may go against you, and then your competitor gets a better price and all of that. Those are questions that need to be answered effectively. So next slide. Now, we've looked at what has happened. Prices have corrected, true. We are now seeing some geopolitical tensions push prices up a little, correct. But what's now happening on a forward view? The most important activity that translates into forward prices for commodities, agricultural commodities especially, is the planting season. So now we came into the year, fuel prices were constant. Don't forget, farmers also use diesel to some extent, petrol to some extent in their production activities. By fertilizers, which is produced using gas. Farmers also leverage on all of these things. They also have their lives to live. So any cost of living adjustment that we all experience, they also have to experience it. So what has happened to planting? Now, we said prices corrected heavily last year. The implication is that some people paid price last year. They lost money. And farmers were some of the people that lost money last year. So that meant that to meet up with their production costs, their own incomes were affected one way or the other. And then we are going into this kind of environment where fertilizer prices have doubled since February, more or less about 68% movement in fertilizer prices. Energy prices, diesel, PMS have also adjusted by a tangible amount. And that will be reflected in what we've seen. So we then carried out a survey of about up to 100 farmers across the country, from the extremes of Taraba to the extremes of Kebbi as well, and every state in between. We carried out a survey and some elements of focus group discussions, and we're asking farmers what they planted, why they are planting what they are planting. Next slide, please. First of all, rainfall patterns. This was what we had before mid-May 2026, where the bulk of the southern part of the country was having rain. We're having rainfalls here and there, but the northern part of the country was not having rains. And if you monitor our production pattern in the country, we usually stagger our production. So some states will start production before others. States like Kaduna South will start production before Kaduna North. The rains weren't coming. So places like Jengre, along the road to Jos, weren't getting the rains they were supposed to get. So they weren't planting. The same thing happened in some parts of Taraba, close to the Bambila, that you typically have planting happening faster. And as you go along that axis towards Adamawa, as if you are going to Mubi, to Cameroon, you typically have rains coming earlier. But those rains weren't coming as early as they used to. So that meant that farmers couldn't start planting as early as they used to, which then means that the early harvest is likely to be delayed, except if they use super hybrid kind of seeds to then boost the production. But then we will question that assumption later. Now, 2025, this was what we saw planted. Sorghum was planted a lot, maize was planted a lot, soybeans was planted well, paddy rice was planted well. But then when you switch into 2026, you can see that there's a sharp drop in maize. Sorghum has gone up, soybeans has gone up, paddy has gone up. So that means that for one reason or the other, for those of us in the animal feeding industry and the FMCG industry especially, maize is showing signs of being threatened going into 2026, 2027 marketing year. Well, you can say you can substitute maize for sorghum, but then that means that you have to do the economics well. On the flip side, the question was, if you are switching, please indicate which crop you are reducing and which you are increasing. You can see sorghum is fairly balanced, so really not so much change in sorghum. But you can see the sharp rise in the volume of farmers saying that they are not planting maize this year. So that's like number of respondents. So this is survey of about 100 farmers, more or less. And then you can see, go back please. You can see soybeans increasing in terms of allocation, land allocation. So typically when the economics is challenged, farmers have the opportunity to switch from maize to soybeans, sorghum, and the likes. But here we can see that soybeans is growing up, paddy is also going up as we've seen it. Now the question is, why are you then not planting what you planted last year? And we can see high cost of fertilizer as a major reason, low selling prices last harvest. So I lost money on it last year. Why should I put money in it this year? These are two critical, and then there are other things that insecurity is also one of them. These are two critical elements that we think we should not lose sight of them. One, because fertilizer prices have gone up because of the crisis in the Middle East. But the question is, could we have intervened in a way to mitigate that challenge? But on the flip side, the low selling prices last harvest is another thing we need to pay attention to, because In correcting the prices that we saw 2 years ago, the government opened up the borders and allowed for a lot of importation. And that's led to a massive drop in prices below production cost. I think it's important for policy makers to also pay attention to these kind of things to see at what point does this policy begin to have negative effect on our local production. So rough numbers, Nigeria has a deficit of between, in some very wild instances, we have a deficit of 700,000 metric tons of maize. That means that if farmers are reporting as much as we are seeing here, that they will not plant maize, that deficit could climb to as high as 1.5 if we are not careful. And it's a drain on the reserves that we've built when we begin to import that huge volumes of maize, which then means that you create a vicious cycle where your import begins to kill your local industry, and as a result, you need more imports, you kill more local industry, you need more imports. And this is food. And the moment you kill more, you are really, really, really impacting households very directly at the end of the day. So this particular slide, notwithstanding the fact that the survey size is roughly 100 farmers, the focus group was also quite extensive, and people reported similar indications across board. So we think it's something that we need to start paying attention to for policy makers in the room, to start listening to how they could begin to think about these solutions in a way that does not kill the local industry. Next slide. Now, having said all of that, we are now saying, so we've seen weather, we've seen the historical, we've seen the current planting season. What do we think about the market drivers moving forward? Next slide, please. So these are the 5 elements that we think are most impactful for prices and availability of these commodities going into the rest of the year and into 2027. The first one is macros and policy impacts, which we've just mentioned, an element of policy. The second one is the fertilizer price shock, which is already playing out. The third one is the security deterioration. We saw this happen sometimes 2021, 2022, but the effect of that didn't really play out until late 2022 going into 2023, because the more farmers can't access key producing regions, the lesser the volume of food we get, the lower the volume of food we get, and the higher the prices we have to pay for these food items. And as we are going into an electionary year, it's important that we pay attention to all of these things as they become super, super important. The next one is the weather risk. We've seen delays in rainfall, correct, but there's a second level of weather concern that we are beginning to have, which is the El Nino, super El Nino risk that is emerging. And we'll get to the next slide to talk about the super El Nino risk. Basically, what it does is that it increases average temperature globally, average sea temperatures globally, and it disrupts rainfall patterns. So places that should get rainfall, they get lesser amount of rainfalls, and some places get huge amount of rainfall, and neither of them is good for agriculture. So places like Southeast Asia get excessive rainfall, impacting the vegetable oil complex. So palm oil, soybean oil, and all of that is extremely affected. Places like the equator, where Nigeria sits at the moment, you get less amount of rainfall. There's some threat of drought in some instances, which in fact it impacts heavily cocoa, cashew, maize to some extent, soybeans to some extent as well. So we think weather is becoming quite important to watch. The margin compression is another thing that you want to pay attention to. If farmers have lost money, that means they don't have as much money to expand their farms. They can't invest in the farms. The kind of investment they should make, they can't make those kind of investment. So these 5 supply demand elements are what we think would be very important going into 2026. Next slide, please. Now, expanding a little bit on the super El Nino crisis. So El Nino is pretty standard. There's increase in temperature a little. But the one that is predicted to the tune of about, I think the last probabilistic number, between 78 and 82%. likelihood of occurring between July and I think September. And that's the most important period for planting. July and September is when the fruits, the flowers are maturing for most all the crops, and the pods are filling for soybean. The cobs are also filling for maize and the rest. Now, if you look at the impact, you see that literally all commodities are exposed to a super El Nino crisis. So we think this is something that people should pay attention to going into 2027 as well. Next slide, please. On the back of that, next slide, let's skip this one. On the back of that, we then said, well, what would that look like? What will the scenarios now look like? Next slide. So as of today, based on what we've seen, we are bullish to about 40%. So the scenarios are spread across three scenarios: bullish, bearish, and bearish. So as of today, we are bearish to about 20%. And the most important element in that bearish case is government policy. If the government continues to allow for more imports, it gives us short-term solution on the part of commodity prices, but of course, long-term challenges. But at least in the short term, it saves commodity prices from ballooning as well. In the base case, which is to the tune of about 40% likelihood of occurrence, we think that, okay, notwithstanding all this challenge, let's assume everything stays steady and we still get some element of production, maybe on the back of the seeds that were planted and the likes. But the one that is calling for concern the most is the bullish case, of which we are beginning to see multiple elements of it at this point in time. So we are already seeing reduced 2026 planting. We already see persistent fertilizer shock in the active security deterioration. Delayed rainfall is already playing out. So that looks like the one that has more of its elements playing out faster and more intense than other elements. So the base and the bearish case, even though you still have some elements that could play out there, the elements in the bullish case seems to be the ones that are manifesting the most, and it calls for attention in the right quarters. Next slide, please. So for us, takeaway for you, if you're a procurement officer, you're a chief operating officer, a chief executive officer, you are in charge of policy, you are an investor, takeaways that you should be looking at the upside factors, farmers planting reduction, pay attention to it. So as we go into the rest of the season, we would continue to engage our clients and notify them of what we see in the market. Fertilizer shock persistence, that is already playing out. So as we go into the rest of the season, that may not be really, really important, but we watch how far it's now. Security deterioration, we watch how much of it will continue to happen. Hopefully, we make gains against all these challenges. And the global geopolitical escalation, we hope that it's eliminated as soon as possible. But the longer it stays, the more challenging the environment becomes. The downside risk factor, you have the government's intervention, which is something that's possible. Early arrival does not look possible at this point in time. So we think we can rule that out already. Naira appreciation is another one, given the work that the monetary policy authorities are doing in getting this resolved. So upside risk factor, please pay attention to it. Downside risk factor, please pay attention to it as well. Thank you very much.
I'm going to get a standing ovation for my colleague. You know, it sounded so smooth. At some point, I was going to ask him that, Yusuf, where's your slide? Because he was just running it from the head. And I think this further gives the comfort to credible partners in the room and online to say Meristem is equipped with professionals to manage whatever you invest with us. A round of applause again for Yusuf. So now we'll be gearing ourselves up for the first panel session, which I believe a lot of the things discussed already by Yusuf will be further drawn down, explanations done to it, the whole security challenge, weather and all that bits. And to drive that session, again, would be Yusuf Ogunbi, who would be sitting as the moderator to the first session panel. And the panelists on this session would be Evans Obayayi, the supply chain manager, Nestle. Round of applause for Mr. Evans. Is he in the room? Oh, fantastic. Please make your way to the stage. Thank you very much. Also joining us for the first session would be Olaoluwa Bamigboye, founder, heirs and Herald Agro Allied Limited. Thank you very much, Mr. Olaoluwa, for making our time to join us. And finally on the list is Abhinav, commercial and business head, Soya Crush Royal Oil. It's a pleasure to have you here. And the moderator, Yusuf Ogunbi. Let's not treat him like Harale. Is a special man on this table. Thank you very much, Yusuf. Over to you.
Thank you very much. I don't know. Will I just hold it? Oh. Yeah, thank you very much, everyone on the panel. I think the guys on the panel deserve a huge round of applause. Not just for coming. Thank you very much for coming, but also because of the hard work they've been doing for the last 2 years. It's quite exhausting. A lot of us don't pay attention to the supply chains of what we consume until we start seeing prices going up in the market. Thank you. We start seeing prices going up, but these are the people doing the hard work to at least reduce how fast those prices are going up, and how much more you have to pay for these items. So thank you very much, Mr. Abhinav. Thank you very much, Dr. Olaoluwa, and thank you very much, Mr. Evans. Combined between these guys, they probably consume, I think roughly about 700,000 metric tons of commodities. So good volumes. That means that they have good insight about what is happening in the market. My first question is how markets? How are you guys coping? How is the market treating you? We start from Mr. Abhinav. How is the market treating you?
First of all, thank you, Yusuf, and good morning, everyone. It's great to meet all of you and understand how new companies are coming into commodities, agri-commodities in Nigeria, and it is always a appreciable step from our side. So coming back to your question, Yusuf. So see, I can speak mostly about soya beans. Soya beans production in Nigeria is around 1.2, 1.3 million in a good year, if the rain and the weather supports it. Out of which, let's say, if I have to talk about local consumption, I need only 800,000 tons of soya bean, which will be consumed in Nigeria. Mostly around 600,000 of it will, 700,000 of it will be converted into meal and be used for the feed industry. So anything over and above that will go for exports. And exports depend on one thing. If the local prices is higher than the export prices, or mostly the competition is from the genetically modified beans from US, Nigeria, mostly South America. So if the price is lower than the South American prices, then it will go for exports. Otherwise, it will all be consumed within the country itself. And in that case, the prices tend to be significantly lower. It is mostly the exports which pick up the prices. So, and again, for exports, as I mentioned, Nigeria is mostly a non-genetically modified soybean grower. So the only exports that you can expect is from India, or sometimes maybe once or twice a year from some European countries. So your market is determined mostly by Indian demand. So like this year, if I have to talk about, we started the season at somewhat 500 naira, and the prices have climbed up to 800 naira. And this was controlled. This is not something that has increased unchecked. This was controlled by beans coming from Benin, beans coming from other parts of the sub-Saharan region. Otherwise, if it was not there, the Indian demand would have increased the prices even further. It might even have been 1,000 naira. So mostly it is what uh, countries like India that drive the price again here, and this is what the topic of this discussion also is. So the volatility in commodity prices. So you don't know which factor where will determine your prices. So like I mentioned, if the crop production in India this year is good, then maybe next year the prices will be low. We'll see. And as Yusuf mentioned, the farmers have switched to soybean this year, some of them. So the soybean cultivation in Nigeria is going to be good, permitted the weather supports us. And if India also the production is good, then we'll see very good market next year. Maybe we'll start the season again at 500-600, even though the buyers have very low stock. Will have very low stock at the end of the season. So mostly it will be determined by export demand and then the uh, type of production that you have. So supply and demand, it is a basic uh, drivers that will drive the market this year.
Yeah, thank you very much. I must add that the Nigeria soybeans market flows into the vegetable oil market. So the vegetable oil that we all consume in our various houses, the soybean market contributes to that. Mr. Dr. Olaluwa, what can you say? How's the market treated you this year?
All right, thank you very much, and for that beautiful, presentation. I mean, you probably said it all. You saw into probably, the production pattern, consumption pattern, and then alternatives. More like, I mean, like you said, soybean production in Nigeria, soybean meal, maize, alternatives. I mean, for maize, no alternative yet. Cassava peel meal is still struggling. I mean, I'm in feed production. So going now to soybean meal, I mean, the price of GNC is matching up. And, before now, all times high of soybean meal, but thankfully, stability in prices, FX, policy and everything, it made it stabilize a bit. But soybean meal as well, 2, 3 years ago, diesel price and everything, soybean meal, GNC went up more than soybean meal, and then people ignored that, for soybean meal. But now, stability in price, and then there's now alternative for soybean meal. People are now trying to look into GNC, in place of soybean meal. So it's been good, but some people are actually affected by, like you said, farmer crying, that wooden commodities are crying too long because they held it too long, and then imports catch up with them, and then they actually are not happy about everything like that. So thank you.
Okay. And on the FMCG front, we have Mr. Evans. How markets?
Okay, so good morning, everyone, and it's good to be here. Thank you for having me. And of course, your session was very extensive, and the learnings are always very important for businesses like us. But if I'm to answer your question directly, market for 2026 has been fairly good. Good in our own context, it's simply because we have an expectation in terms of volumes, what we want to achieve, what we want to do, what we want to sell, what we want to produce, and at what price we want to sell. And for us in the production space, we are much more focused on the demand, the offtake, how the market is accepting our product, how we are competing effectively in the market space across our various categories, which are household consumables for most of them. So for the year 2026, it's been pretty very much very good. I think the most important factor we are enjoying today is the stability we have in the macroeconomics. When this plays out, what it helps us to do, it helps us to plan much more effectively. It helps us to have a clearer forecast, a clearer future, and then we can anticipate whatever changes. And a forum like this also give us business intelligent insights that helps us to take some decisions. And already while you were speaking, a couple of decisions are already taken on what we need to do going forward. But generally speaking, it's been fairly stable. The geopolitical crisis, the issues around diesel, really, it's an unpleasant one, actually very unpleasant. But that's the major whirlwind we're actually trying to manage. But other than that, consumers' trust in our product is very strong. It's been the same all over across the decades. offtake of our product is pretty good. Our production is also at a very good position. Thank you.
Let me stay on FMCG because last year we saw huge recovery. For my equity analyst in the room, I can see she's nodding at the back. We saw huge recovery in the FMCG market. So the question I would like to ask is, on the one hand, the plans this year are going as expected. What would you, as someone sitting on your desk, what would you like to see in terms of market structure, market arrangements that would make, even when the volatility is coming, because you never can tell, you being able to predict how the market or how that volatility will impact you more? What would you like to see in the market in terms of contracting, in terms of risk management, those kind of things? What would you like?
Okay, so I think over the years, there are a couple of things that we have done as a company that has really, really helped us. And you touched one of them already when you said contract. The kind of contracts we have, the kind of partnership. So basically what we would love to see more in this sector, it's more partnership-based relationship, long-term based relationship, long-term investment around infrastructure. And most critical these days sits around processing. So I don't know if that fits in the scope of what we're discussing today. But just to recap, it's really more on long-term partnership, which definitely would involve the kind of contract we have with the, let me use the word, the sellers, the traders, the kind of contract we have. Because at the end of it all, for most companies like us, what we try to do is to edge against all of these insights you have given. So it's either we're running on some level of forward contract or we're running on some level of future contract. But you know what happens in all of these contracts. It can work in your favor. It could also go against you. It sits on both ways. But for us, it's we pride ourselves much more in decision making. We pride ourselves much more in pricing. This is the price, this is the all-time high for the year that we have anticipated, and this is how we want to position ourselves in the market, and this is the price that will drive our commodities. And sometimes we hope that the consumers will be able to afford some of these things. But typically, over the years, what we've done is to edge against all of these prices, is to also invest in some level of infrastructure, which I could talk more about. Because what you get to see is that there's not much storage outside in terms of these grains. But for us, we also have invested in some level of storage and gives us good time. So we are able to latch onto the market when we see good prices, collect all of those contract volumes, store, preserve, make sure they're in good condition, and then we're able to get good covers from now till the end of the year. So sitting here today, I could already tell you that I have good cover for some of these concerns that you have. Thank you.
You see that last statement he made is such an exciting statement for somebody in that line. I'm covered. Don't disturb me. So, Mr. Abhinav, on your side.
But sorry, just to add, I'm only able to be covered because of my size. But
Correct.
vast majority of the companies in Nigeria may not have that economies of scale or that size to be able to secure, even to drop a contract that is to your advantage. Sometimes your size depend. Also know that sometimes we trade not just from a national context, but we are also large as a group, Central West Africa. So sometimes when we're having this contract, we really, really have the volumes that could drive some of those contracts. So I needed to mention.
Fantastic. I like that angle because, which was why at the beginning of my presentation, I said it's a commodity solutions desk, not a commodities trading desk. Because we've seen that kind of issues crop up. So they are the big guys, the Olam Agri, the Nestle, they are big enough to cover their needs all through the year. But there are some other mid-tier, small-scale businesses that are credit-worthy actually. They have good business relationships, but they are not able to solve that problem because of capital need and all the likes, which we are glad to provide as needed. Mr. Abhinav, if you look at the market, Olam launched probably the largest vegetable oil crushing plants in the country last year, 300,000 metric tons capacity for soybeans. What excites you the most about this market?
Okay, so first of all, starting with where Evans left it, we had a discussion a couple of days back. I am covered for this year. Uh, so coming back to your question, uh, see, vegetable oil, based on the current market scenario, the war in Middle East, because of which the crude oil prices have increased significantly. When crude oil prices increase, then there are some alternatives which are used as biodiesel, palm oil, soybean oil. So if you'll have to ask me, if you'll ask me that whether I want to enter into a long-term contract in this market, I would not, because I know every day the soybean oil, the vegetable oil prices is going to increase. So as we say, I was discussing with your group MD, so hedging. So in such a market, I will never go into a scenario where I have to hedge my risk, because I know every day I stall my sales, every day I stall my dispatches, my prices and my return will increase. But again, there will be a time when again the soybean, and we produce a very small segment of the total vegetable oil requirement in Nigeria. So let's say we produce some 5,000 tons monthly, which is nothing. So I can play with that. I can play with the prices, and I can use that return to hedge my risk on my soybean meal side. So soybean meal, as my colleague mentioned, um, soybean prices increased. Soybean meal prices did not increase to that level. So I can use these instances to play out the future risk that I have. So this is what we have been doing this year. Again, vegetable oil, as you mentioned. So we are not. I am not the one exactly doing the refining of it. I am doing only the crushing of soybean and supplying the crude soybean oil to my downstream partners, the vegetable, the refined oil team. So as long as, and they, in addition to what they are buying from us, they import a lot of palm oil. As I mentioned, palm oil prices have gone up, so soybean oil prices have gone up, and this is the reason we uh, launched this refined soybean oil brand at this point of time, and this is why we are going for an expansion of our refining capacity as well. So at least in the near future, I am seeing that the soybean oil prices will be on the high, will be increasing for maybe a next 4 5 months. And so this time I see is exciting. But again, we need to hedge the risk. But since I mentioned that that is not a very big product in my portfolio, soybean oil. So in terms of Nigeria, I produce a very small percentage. So whether I produce or whether I increase will not impact the overall market dynamics in Nigeria. So it's fine, it is there. But the main business that we are in the feed business, and soybean meal production is what is driving our business.
It's interesting to also say here that the vegetable oil market in Nigeria has expanded to the point where we now have three layers in the market. So we have the raw material, soybeans, we have the intermediate product, crude soya oil, which is bought by refiners, and then we now have the refined soya oil, which we all consume in our various houses, and which is a significant maturation of the market. It tells you that there's solid investment in
There
that
is
market.
one more level.
Right.
So there are refiners, then there are bottlers.
Bottlers.
Yes.
Okay, correct.
So refine and they sell to these bottlers. Bottlers are the one who make their brands and sell it to in the open market.
Correct.
So it is almost a 4 level industry.
It's an exciting one. So it tells you how much investment is going into this market and how people are confident about the fundamentals of this country investing in these kind of businesses. Dr. Olaoluwa, the animal feed industry is not just important as an industry. Yes, it makes its own profits, it generates its own revenues, but it's very important for the poultry industry. Without that, we probably would be importing all our poultry from Brazil, Malaysia. So how on your side, what have you seen? Because we saw the decimation of the poultry industry following the sharp rise in prices. Most farmers are mid-tier, small-scale farmers. You have the large ones, but not so many of them. So how has the market more or less evolved this year? Is it recovering? Are we seeing recovery? And what may be holding back the recovery you've seen so far?
All right, thank you. So yeah, recovery, yes, and it's gradual. Not, it won't happen suddenly. But unfortunately, when there was a crash, it was bearish. It was bullish, pardon. A lot of farms shut down. I'm based in Ekpe. Ekpe farmers shut down. Going to Ikorodu, going to Owode, Itokin area. A lot of farmers shut down because maize price, soybean meal, which forms 70% of the total cost of production of feed, were on the high side, and it's unfortunately unsustainable for farmers, and they had to just lock down their prices. But unfortunately, coming back to 2026 now, maize, from large suppliers is like, between 240 imported grains, and then local ones 350 to 440. So it's getting, variable now. It's getting better than the high, 750, 1000. I mean, in the last 2 years, it sold for as high as 1300, for last mile, like you said, depending on where you are buying from, adding transportation, logistics, and then having to pay at different points, different borders, and settling different, government people. So now it's getting better, thankfully, for the likes of Olam, like you mentioned, and some other big guys that are playing in the refining sector, which makes it affordable for farmers to be able to buy soybean meal. Because before now, like he said, they are contract manufacturing for themselves. Big guys manufacture for me, we take from you, and it's not cascading down to the last mile. And it affects a lot of people. So, but now they are, opening up a bigger plant now helps last mile farmers or smaller farmers to be able to buy. Like you said again, people that they don't have capacity financially, infrastructure wise, to hold in bulk. It's just buy on demand. As you need it, you go and buy it. If it goes up, you lose your margin, gets tighter, and then if it goes down, probably for a while before you know it, that's gonna begin. So it's getting better. It can get better, but thankfully, like I said, for the likes of Olam Agri, for the likes of Apple and Pears, a lot of them in the north as well, they are making it a bit better. Going back to imported grains, the policy is somersaulted, inconsistent, but it made it better in some way as well for farmers. For poultry farmers now, but for crop grain farmers now, they're actually not happy about the policy, because imagine planting and hoping to sell, but unfortunately, because of the cost of input, fertilizer, grain, seed, and different things, they're not able to sell at even the product cost. Like I mentioned, the animal market, right? For the import is look at as high as 420 rand. So just like some are smiling, while some are smiling. So that's what it is for now.
And what's the situation with the day-old chicks now?
Unfortunate, and it's just like people have to pay ahead to get part of what they paid for. Imagine paying for 10,000 birds, and then when your day probably to pick up is ready, you are picking up, let's say, 4,000, because it's actually they have to share within themselves. Grandparents talk, parents talk. Importing bottlenecks, FX volatility is still actually affecting that side, and then even the cost of production, cost of energy. Energy cost in Nigeria is not cheap. Going to power, and then even substituting now going to diesel is not cheap. So they are not able to meet up local production, and then it goes to increase the price, affecting farmers that are actually producing for probably chicken, meat or egg.
We heard this complaint a lot. I'm hoping our panelists for the second panel are here. One of the problems we heard a lot with the processors, manufacturers, is the question around energy. So the second panel is supposed to discuss alternative energy solutions for manufacturers and producers in the country. As we wrap up, Mr. Evans, what in your own view, so this is for my equity analysts and those looking at our very good portfolios. What should we be looking at? So you said that cost of raw material stable. So we can be confident that COGS will not jump up as much as it did some years ago at the end of the year. So financial statement at the end of the year, we should be looking at good angles from that regard.
Okay, yeah. To answer your, I don't know if I should keep your. Okay, to answer your question, it's already half year. It's already half year, and we should be closing H1 by the end of. But Q1, Q2 has been positive technically, but we know from historical context in Nigeria that even the last 3 months can mean a complete turnaround. It's a function of how the global issue specifically deteriorates. Most recently, also, not most recently, it's been there for a while. It's a function of how the security concerns are tackled. It's a function on how the government decides to manage investors' confidence in the country. It's also the year where there's a whole lot of preparations for the forthcoming election. So all of this um, will play a key role in H2. But what companies do, I believe most companies do the same thing, is that you try to also secure some amount of your full year gains, even in the first half of the year. So you will try to push more volumes in Q1, you try to push more volumes in Q2, you will try to leverage on the demand, you will try to stay above competition in the early days of the year. But I recall a couple of years back, 2, 3 years ago, the last quarter of the year could be very, very devastated. So we really need to be mindful. But generally speaking, the outlook still look a bit promising. But I would love to touch one point you also had mentioned, the issue around import versus imported grains or commodities versus local. Because I play in the space of a buyer, we need to also be very careful, even as Nigerians, since I'm also in Nigeria, in managing all of this. One key thing we need to know is that companies would always find ways to survive. And no matter how desirous they want local local sourcing alternative, there is also the mindset of the cheaper alternative. So we need to be mindful, and that's why I talk about investment in processing and all of those infrastructure. We need to be really, really very mindful, because at the end of it all, the policies the government make is driven by some of the key stakeholders. There is the Manufacturers Association of Nigeria. If the association goes up to the government today and tell the government today that I do not have sufficient grain, because we already know that there's some level of shortfall in terms of national requirement, the government will have no choice to open up a little bit the policy, because these companies also, on the flip side, need to continue running. They need to continue generating taxes that we all need for a better country. At the same time, when you see that prices are way, way, way cheaper coming from other countries, the next thing is every manufacturer like us also want to be close to our raw materials for proximity. I do not want the global issues to affect my supply. The global issues also impact pricing in terms of freight. I also do not want all of this to affect. So I rather want to come to Ikorodu, go to Ekpe, and get all my raw materials. But there's also the big question around quality. Um, Today, there's a whole lot of online advocacy around the quality of product you produce. Today, we are in times whereby you just cannot, if you pick a product from Nestle and you find anything wrong, I bet you would not just stop there. Somebody would then put up the camera, put the stand, and of course make a fuse out of it. Really, it's a big concern. So talking about quality, the world today expects us to have quality input raw materials. And one of our big challenge, just in case we're not talking about challenge, is the quality of the input raw materials that we have. My category split from culinary to beverage. Now, the difference between culinary and beverages is that culinary pass through a cooking process, some level of tolerance. Beverage is direct consumption. It's just dissolving water and then you drink. Same thing with cereals. So if I'm talking about my cereal category where most of my grains would go to, it means that I need some level of quality grains. In fact, they call them infant grade grains, meaning that it goes down up to the quality of fertilizer you use, the kind of soil, the kind of storage, the kind of fumigant you use, and all of these things. So I just felt this is important for us to have a broader context on how we manage the value chain from farm to fork at the end of it all, to be sure that we also help the government create those policies that would help local farmers. Thank you.
Fantastic. First of all, balancing. A round of applause, please. It's balance is very important because at the end of the day, not one sector dominates the economy. So you want to balance it out as the government, and we think that's the best way. We absolutely agree. Balance is very important. I also agree with you about quality. That we just can't keep doing the same thing over and over and expect a different result. It's not possible. It's not possible. Sabina, do you want to add a thing or two to that? On challenges, basically, what would you like to see differently in the market? What would you like people that are majorly selling to you, dealing with you, to think differently how they maybe supply their goods, deal with you at the end?
So, as Evans was mentioning, the right balance between the local procurement and import. So, if I let's say import soybeans, there is a very good chance that I'll get something which is very low in foreign matter. So I'll get something like 1%, 0.5%, which is clean soybeans. That will be very easier for my plant to process, and I'll be able to crush it at a very good rate. But local Nigeria, so the price at which they are selling the local Nigerian beans, so the farmers are making lower profit. So what they do is they mix a lot of sand, they mix a lot of stone shafts in the beans, and the impurities go up to as high as 5 to 6%. So again, as Evans mentioned, we need to find a balance whether running the plant at that capacity makes more sense to me, or whether the price of the Nigerian, see, because Nigerian beans is uh, equivalent or maybe even better in quality than imported beans in some aspect. So with Nigerian beans, I can get a greater crude protein in the meal. So that is something where I have to check before making such decision. Even if, let's say, the price at what percentage of price difference does importing beans makes more sense for me. For example, in 2024-25, that was the first season since Olam has been here in animal feed. That was the first season that beans were imported. Around 6 vessels of beans were imported into Nigeria, and thankfully this year that all changed. And as Yusuf mentioned, last season was a very tough season for us. A lot of people hoarded, a lot of people made losses, a lot of the soybean crushers made losses. uh, but this year we saw Nigerian beans were coming at a very good price because of the high stock in the system, because of good export demand. But again, next season, if I have to look at, um, it will be a buyer's market. If there is, people will have very low stock on account of high exports this year. So if at the beginning of the season, first of all, of course, as per the product availability, it will be a buyer's market. So if at the beginning of the season there is good export demand, people rush to cover their requirement, then we might again see the price of Nigerian beans rising to an unexpected level. So that is something we have to look out for and take the correct decision at the correct time. Thank you.
Thank you, Mr. Dr. Olaoluwa. What would you say in terms of challenges that because for us, we think that's where we have a lot of value to add. Those places where you see those challenges, you've mentioned quality, you've mentioned balancing import versus local demand. We think there's value for us to provide there. So, what would you say in terms of challenges that you would like to see resolved in your space?
All right, so yeah, high cost of funds for livestock feed for producers and even for farmers as well. Like I said, ideally, any livestock production consumes, for production, our crop production, any farmer, the cost of feed, goes to like 70% of farming. Anything you are doing there. So now going to even the cost of feed now, cost of soil, cost of maize, consumes as high as 70% again. So if there can be affordable financing for farmers, for farmers, crop production, and then for even poultry farmers or livestock farmers. That will probably go a long way to help. Same thing for contracts in manufacturing. Like he said, comparing energy of imported grains and then local grains. Now there's a balance, because before now, when government calls us come and say come and take up imported grains, we reject it because of the low energy. In maize, we analyze and then we see that if you are reducing the quantity versus the energy level, you have to probably now go for more higher quantity of imported grains rather than using, let's say, 50% of local grain, and then you match up. Now going back to imported grain, you have to probably be using 70 to 80%, and then the cost eventually will balance up, and then there's no point anyway going for the imported one. So now there has to be a balance, which is now coming to play, but at the same time, any farmer that is actually willing to work with contract manufacturers, local farmers, will say, let's support you. Going to production, I mean, unfortunately, there are some states in Nigeria that produce adulterated products. I can't mention names, pardon me here, but they are known. We know, right? Yeah. So they are known for that, and then they dominate the market as well. They dominate. So, I mean, I get what you said, concerning culinary beverages and then cereals. There has to be regulation as well. There has to be hands-on regulation. I remember now, adulteration and then what's it called now for drugs in vaccines. I mean, they are not potent anymore. High antibiotics, resistance now in poultry, livestock. So all these things are there. So regulatory has they have a long way, to go, and they have a role to play to enforce and to ensure that this thing last mile beyond the policies, in the offices, they enforce, last mile to be able to. And then now going to logistics. Before now, transporting stuff from Apapa, Witofa, and the likes from Apapa to Ekpe used to cost me 200 and something thousand naira. But now it goes as high as 800,000 naira. In some cases, they have to probably beg for 900K to transport the same quantity, less than 3 years. And then that probably impacted on our prices. And then, like I mentioned earlier, they'll probably stop your vehicle at any point, to say you have to pay certain amounts. And then there's not a budget for that on its own to say, for different guys on the highway, you have to pay after.
It's handling and logistics.
Yeah, so you have a name for everything. It's okay, but it's just unfortunate what we're experiencing right now. So there has to be, checks and balances. If you want food to be cheap, we have all to probably, put our hands on deck to enforce, balance. Because I mean, you probably are saying you have to generate revenue for the government, but at the same time, you are saying we should, make food affordable. So there has to be like a proper handshake between the government and then the producers.
Thank you very much. I hear balance. I hear contract sanctity. I hear infrastructure. I hear quality. I hear financing. And I think that's been a fantastic one. It's been an exciting time having three of you here on the panel. We appreciate you coming, and thank you very much.
Thank you very much. Thank you. The discussion goes on and on. Yusuf, I think at some point I wanted to understand that logistics and handling. Maybe it could be another stream of income, because Nigeria, one way doesn't make the income right. So swiftly, we're going to delve into the second session. There was a couple of questions online, which I would love to take, because I thought it would be useful to everyone here. For you with us, so you would guide me on who to. There was a question from the online audience, and I thought it was good to ask. The question is, what has been the visible role of state price control boards in the market? Do you want to respond, or to any of the other panelists?
Yeah,
to just educate the audience.
So state price control boards don't exist in Nigeria. We don't Nigeria is a very liberal market when it comes to commodities across board, not just in the ag space. It's actually across board. It's a very liberal market, and we don't have state price control board. What we've been able to leverage over the years to maintain affordable food and affordable prices is solid infrastructure, solid production environment, solid financing. For a long time, food prices were actually kept in check until I think the 2020s, 2021, and sequel to that. So we've maintained a very open market in even managing prices across board, and it has worked for a long time. I think we just need to double down on infrastructure, double down on security, double down on financing, and all of those things. If all of these things fall in place, prices will go back to will remain affordable. And don't forget, even in environments where price control boards work, if the prices are too low for producers to produce, they will just stop producing. And at the end of the day, the price control board will even have to adjust prices upwards to keep volumes flowing into the market.
So I would say, do you want to address this your message to the right party?
Come again.
So there was another question where it says, if X used to be the platform for us retail investors, are there alternatives without owning physical commodities? I think you have the right answer.
Yeah, Meristem has a commodities fund which will be launching today.
I don't think you echoed that enough.
Meristem has a commodities fund which will be launching today, and I believe investors will be able to participate in the fund. There will be a small presentation for that fund sequel to the second panel, so please watch out for that, and you'll be able to participate.
Thank you very much, Yusuf. And on that note, I would like to usher in the next panel session. Yes, another question in the room. So let's over around. I'm coming to everyone now. Thank you very much for nudging.
There was a discussion of quality, and I was wondering what's the relevance of or the role of the Standard Organization of Nigeria, SON. Is it relevant to the commodity side?
One way or the other. So SON works closely with SEC, which I'm very aware of, the Securities and Exchange Commission. So the standards that the Securities and Exchange Commission has was jointly developed by SON and SEC. On the commodity trading side, there are a number of other agencies. So there's the Federal Produce Agency that is also in charge of grading and standardization of quality as well. So it's not just an SON thing. So at the very corporate level, SON is active with SEC, but at the operational level, there is Federal Produce as well. So,
Thank you. So in addition to that, I mean, just a typical example in livestock feed industry. I would like to say that imagine someone loading 30 tons of maize to top feeds of Nigeria, and then high quality checks, standards and everything, they rejected the maize, saying that maybe impurity level, foreign materials, and then aflatoxin. But unfortunately, that same maize will be sold, maybe 30 kilometers around that area. Do you know? I mean, just letting you know to say that. And that same bad maize now goes into production of feeds and then, poultry, and then we consume that same bad maize. So I mentioned something like to say there's a disparity between policy, stating policies and writing policies, and then enforcement last mile. So last mile, there's still a dearth of activities last mile. I mean, people are in the offices in Oshodi, Apapa, writing policies, dishing out and different things. But unfortunately, there are no field agents to enforce all of this to ascertain that whatever is said is actually maintained across board, beyond high companies and low companies and then players in the industry. Thank you.
Okay, there's another question in the room.
Yeah, good morning. I'd like to direct my question to Mr. Mbinoff. My name is Shola Laka from Flour Mills. I'm swayed away with your data, and I I like to also want to talk about it. You made mention of soya beans production 1.2, and the local consumption is 800. So we have a gap of 400 to fit to the international market. Yes, gap. Yeah, yes, that's to export. Yeah. So we had it good 2023, 2024. It was bad in 2025. But we had it good 2023, 2024 exports. Was yes. Yes, we had it good. Yeah. So 2025. So the price was down. And so our own understanding is fact that there's short crop in Nigeria. That led to imports of soybean seed into the country. Oh, my question to you now is okay now.
No, please.
There's no parity here today. That's by export of soybean meal. The margin is just too thin. The local price is also competing with the international price. What's your view in the next 2-3 years? Are we still going to be stable? Or we just back our backs, look into another thing? Thank you.
So see, there is a difference when we talk about Nigerian beans. What is so special about it? It is non-GMO beans. So it will always give you premium in non-GMO markets. And that is why in my first answer, I mentioned India so many times. India is your biggest market. And India this year, the production was low. Again, it depends. Whenever Indian production is low, they'll come to you for exports. But you can never say that if I have more, I can export. So that is the problem. And this is what we saw in 24-25. So 23-24, there was a lot of exports. 24-25, there was a very bad production and low supply, and the prices went very high. So that year, exports was not visible. People started importing. This year, again, the prices were very low, and exports happened. Almost 405,000 tons of beans and meal got exported from Nigeria, mostly to India, and meal to some other African countries, even to Europe. Next year, in our view, it will all depend on the as I mentioned, the production in India. So if in and right now, as you mentioned that right now the prices there is no parity. Right now there is a massive demand. Let me be very clear. India has cancelled some 25-30,000 tons of meal export order they have, and they have booked some 80,000 tons from Nigeria, Benin, and some African countries. So this demand will always be there. Only depends on the total produce in India. That's it. Because they will never use non-GMO. They have just allowed non-GMO oil to be imported from US. But non-GMO meal, sorry, GMO meal, GMO beans, they'll never export, never import. So there is where your advantage is. And Nigeria is one of the biggest producer of non-GMO beans. So that is the main factor which depends. If India has a good production, prices will rise up. Otherwise, it will be lower, and the producer in Nigeria will benefit from it.
Thank you very much. And okay, one more question in-house before.
So thank you for the presentation. So my question is to Doctor. So I'm actually a livestock advocate because I studied livestock in school. So my question is, at 2026, we are still having issues concerning poultry production and all sorts of things, which is the basic means of protein. What is the other advancement in the other part of livestock production, the ruminant and likes? Because 2 years ago, I read a report from FOA and concerning Africa livestock production that by year 2050, we're going to be having a meat to 10 heads. That means 10 heads are going to be struggling towards consume one meat. That means there's going to be definitely probably those that can afford it and those that cannot afford this. If by 2026, we are still finding issue concerning poultry production, which is the lowest basic of production, what is now the advancement, or what are we actually planning ahead for the other livestock because part of what is highly costing livestock production in Nigeria, basically the feed and also the security part. And also the those are actually like the larger percentage of it, those are the northern parts. And the insecurity comes in also. So we have a lot of crisis in this aspect. So what is the preparation about that?
All right, thank you very much for that question. So, two things. I will talk about indigenous protein, production of protein. Before now, maybe people in their 40s and probably mid 40s and above will know Akuma Diju, Money Money. I mean, yeah, you might not know. Apologies, but these are proteins that were indigenous and they are produced locally. They were they were produced and they were actually good proteins for consumption. We didn't die growing up. But going to if protein will be cheap or not still, lies with Olamagre, the likes of because soy and maize form 70 to 80% of cost of production of livestock feed. If those keeps going up, there's no way, there's no magic to cost of production for feed and then scaling down to production of what's it called now, poultry or ruminants. So now going to domestication as well, as much as possible, we have to backyard farming. I mean, there's this products from FUNAP, Noila, Noila birds. Noila birds, they are able to multiply by themselves. What broiler does is to multiply. I mean, in 6 weeks it gains weight and then it slaughter at 3 kg. What layer does, after 2 years it lays and then you sell. But Noila is a dual purpose meat. It can rear for meat and rear for eggs. So backyard farming of that, keeping 5, 10 by yourself, they multiply by themselves as well. You incubate, you hatch, and then it helps to lower the protein deficit in Nigeria. Thank you.
Thank you very much for that. I got worried when he spoke about the FOA report, and FAO, right? And I remember a colleague of mine who likes meat a lot. So I imagine what she will be doing in 2050. And I'm sure a few of us in the room already. So there's a last question here from the audience online. I don't know who would take this. Yusuf, you would guide us. It says, given the current challenges in such as climatic variable, import cost, and market price fluctuation, to what extent are farmers motivated to remain in production? Further, it says, what strategies can stakeholders adopt to retain farmers in agriculture and ensure sustainable continuous production? So I think I would take to Doctor and have yourself respond as well. You go first. Yes.
So in that space, there's been a lot of ups and downs, right? So the farmers had 5 good years, 5, 6 good years under the last administration in terms of supports, in terms of even private entities came up and they started doing some element of farmer outgrower. We saw the growth of that segment of the market. The challenges are there. One thing that we have going for us in the country is that our farmers are not just farming for business. They are farming for subsistence and then on top of that business. So there would always be a base production in the country, regardless of what happens. Extract for the rest of us to consume is what we will now be saying, what will we do? What will we do? But I think this points out the question to, it reminds us and reminds the policymakers that there's a lot of work to do in this space. Agriculture is not an easy sector to finance, especially production. There's a lot of risk that you have to de-risk. The question is who will de-risk it? And we know the entities that can actually provide that de-risking mechanism. There's NISAL as well in that space. So we need all these agencies, all these entities to work together and actively, not just like Doctor said, not just on the paper front, but in executing and delivering in all of these things. The capital market is actually ready to support the sector with the right de-risking mechanisms. We just haven't seen them happen at the scale where we need them. Just to put some numbers, farmer production financing is nothing less than, in a year in the country, is nothing less than 100 billion, 150 billion naira. It's nothing less than that. Which means that even if you're a boutique firm and that's the only thing you do, you have 100 billion, even if you take 50% of the market. So it means that that market is sizable. The fertilizer market, by extension, is also another huge market in and of itself. So we think with the right mechanisms, these challenges will be solved because there are improved seeds, there are all of those things which Dr. Khan mentioned.
All right, so thank you. In addition to that, I would like to say that number one is public-private partnership, in the sense that go to Asia, India, where they are processing everything has developed, and then they are now coming to Africa to take over. Is the fact that they partnered with people to say that beyond the government, what do we do? Researchers, MS, Swaminathan in India some years ago, Nobel laureate, what he developed to the government and then research, PPP, is to say that beyond us, let's go, to the public and then private. That's what needs to happen in Nigeria. Going to Europe, some other African countries, Asia, America, their interest rate is just between 3 to 7%. But in Nigeria, I used to pride myself in, taking loans before till the rates go to 33%, 38%. I'm like, Sefini, I have to put a stop to it. So because taking loan at 38% to operate, my margins are very tiny, between 5 and 10%. How sustainable is that? So I had to just put a stop to. So we have to come back to PPP, number one. Number two is affordable financing, and then as much as possible, government is trying, maybe policy, but we have to leave some things to private sector to say, let's hand it over to you. To now, Dangote is in crude oil processing and everything is working well, and Ola Magri, let me give them, that accolade to say for soybean, because the price before now used to skyrocket around this period. We've been buying around 1.5, 1.4, beyond what they are selling in the industry, in the what's it called now? Their companies, people mark it up before it gets to you. You're already paying overboard. But now, them coming to process that scale, magnitude, helps to bring down the price. So, like he mentioned as well, Yusuf mentioned contract manufacturing. But when it came as a government intervention, it failed because government was involved. Because some people saw it as grants, not just a project. So they didn't pay back out of the money called maybe 224 trillion. I think they got back 70%, and they couldn't get back the remaining 30. So as much as possible, I think PPP will work, and then having to set up plants that people can actually walk up to and have access to raw materials, than having to have bottlenecks and then what's it called now, middlemen that will actually increase the prices. Thank you.
Thank you very much. So I think an Operation Feed the Nation model needs to be revamped, I guess, so we don't get into that scavenging point. So at this point, we will take a 5 minute break where we can move around, network with ourselves. There's tea, there's coffee, in case anyone cares for, while we get ourselves ready for the second panel session. Thank you very much. We'll be on break for 5 minutes. Thank you.
What is your view on the way the energy and electricity markets is in Nigeria currently? What are your takes on it?
Good morning, everyone. Okay. I don't know. Okay. Good morning, everyone. Thank you for having me. And I think the discourse has been one that is intellectually, should I say, inspiring. The Nigerian electricity market is in its nascent stage. I think that's the starting point and what I think most people should understand. And when you have a market that initially, for most of us, we probably experienced that growing up, we only knew NEPA, for instance, right? and we moved from having NEPA to having PHC and some form of rebranding for NEPA. right? And then from that stage, you then had a scenario where the market became, it started allowing for some private participation. Starting with the discos, right? And then getting to the Gencos and figuring out how to, merge all of this together. So pretty much, I'll say the market is nascent, right? The government has continued to play a huge part in trying to regulate and control the market prices, tariffs, and all of those things. And what that has done for the um, economy. One of the interesting things that happen. Elections are coming, but remember the last election and remember what happened immediately after the election, where subsidies on electricity and even fuel went off, right? And what that really meant was before then, we had a scenario where prices were regulated, subsidized by the federal government of Nigeria. Now, in spite of that, you had a scenario where you had private participants who were operating, investors on the market, who effectively had, should I say, were not getting the returns they wanted on investment because, again, there is what we call the market shortfall from the electricity market, and there's also what we call the tariff shortfall. So the tariff shortfall is effectively what the government would cover for in terms of subsidies. Then you had the market shortfall, which effectively has to do with collections, ATC and C losses, all the impacts you get from the infrastructure that is inadequate, right? So what's going on today, my view, like you rightly asked, is there's a lot of investment that needs to come into the electricity market. It needs to be open for more private participants. A lot of focus needs to be around how do you close the financial gaps, right, with the technical solutions. So you have to close the market shortfall gaps. So how do you invest in metering systems that are intelligent and smart, right, that cannot be easily bypassed? How do you invest in distribution infrastructure? Because we talk very little about that. We all talk about generation capacity and all that, but really let's talk about distribution infrastructure. How do you ensure that you have visibility on your supply chain? So a good example, the market today, we talk about gas and for private participants and all that, and you realize that the domestic pricing changes from one place to another. There isn't, as regulated as the market is, there isn't a pricing today that even a Meristem can say, hey, anywhere you go, you find this as a cost of natural gas. So those things have to be clear, right? So that investors can have the confidence to come in and know when we put our money here, when we make investments in the infrastructure, in the systems, we're going to get the returns. But again, I personally think it's early stage, right? It's transforming from what used to be state-owned into a privately managed economy sector rather. Thank you.
Interesting that when did we gain independence again? I'm trying to remember, but we are still in the early stages of power development in Nigeria. That's very interesting. Okay, you're welcome. Afolabi. We were just briefly talking about the energy markets. We had a first panel in the morning, sometime, and then we've had a bit of back and forth about the expectations for the agricultural market. And then one thing that we discussed in that panel was the fact that there was the geopolitical tensions that's happened so far. I in my former life, I used to write research reports, and my former life, yes. And there was, I think 2022, we wrote a report and the title was Unending Crisis, something like, I can't remember, but there was, and so it seemed like from then till now, there's always something. There's always Russia, Ukraine, something. And now this year has been, US, Iran. So with the fact that the geopolitical tensions happened this year and basically just gave its own upheaval to the energy market, what are your views on how the Nigerian energy and electricity markets have evolved so far? What pain points do you think your clientele base have, expressed to you looking at that market currently?
Okay, thank you very much. Apologies for being late again. I'm very, very, very sorry. I think the first thing is everybody in this room should thank God for Liquid Dangote, number one. because they'll probably be paying 2,500 naira, 2,400 for diesel, for those ones using diesel. Then I think also thank God for the blessing of having natural gas, because in Europe today they're probably paying about $16, $17 per MMBTU. People are getting gas for as low as $3 in the Niger Delta, who are next door to a flat site, to as high as about $8-9 in the other parts. So that's also a blessing which we also have. A lot of us are uncoupled relatively from all of these challenges. Dangote is reducing the impact, so to speak, of the other bits of it for us. So that is there. Of course, we also still have the challenges in terms of the total value chain. All the things like helium, all the things around the lack of access to gas-related products like fertilizers and what have you. And of course, we are in the planting season in some of the parts of the world. We're going to see that roll over going into next year if people don't get the fertilizers which they need to start planting very soon. How that's going to impact food prices and what have you. So probably the next thing we're going to have to do as a country, because this is more or less agro-energy focused clientele or audience, is going to be around what then do we start to do to ensure that that fertilizer bit is also done. Dangote is also helped in that bit also. So we are not fully decoupled from it, but at least that helps a little bit. So that's really where we need to sit. We've been lucky, very, very lucky. But we need to really start to look at how do we then optimize on all of that. And because I'm also in a place where these are not government people, which are here, of course, maybe one or two government people. These are people who are basically trying to run their business and turn 1 naira into 1 naira 50 kobo. It's going to be around leaving what the government is doing, around what this means for you as a company. And what this means for you as a company is going to be as much as possible where you can site yourself closest to where there is gas as much as you can. If you cannot get access to pipeline gas, get yourself as close as possible to CNG. I think one of my friends, Green LNG Limited, just started their LNG plant, about 7 million scoff equivalent LNG plant in Ogun State. I should see about another 3 or 4 of those coming up. So there's LNG going all the way down to Kano. So even if you have a plant, whether you are Olam, you're in the middle belt, everybody has access to that in some shape or form. The larger problems of Nigeria between you and I are probably, as far as the power sector are concerned, will not be solved by this government. They are multifaceted, they are more. So I don't want to go into all of those challenges. They are not things that can be solved. So I don't want to waste my time. All of you already know those. All of you already mentioned it. He has mentioned all of those things. So once you solve one problem, 20 more show up somewhere, and you still have to pay your shareholders this year. So I don't want to waste your time about that. So I think that's it for me, really. How do you solve your problem? How do you reduce your exposure to diesel? How does renewables come into it? What is the perfect mix based on the realities of your business? If your business is one that is heavy, then do you now need to look at, is it more going to be focused towards gas? If it's more a little bit of processing and what have you, then renewables can help. Or even in between those two, how can you then have a right mix based on the realities of your business?
Okay, interesting. I'm going to stay with you, Mr. Falabi, and I like we both touched on gas. There's this joke on the internet where someone says, "Oh, I'm into oil and gas," and you ask which of the gas is the and which of the oil is it palm oil, and So for us, you both mentioned that you need to understand. Business owners need to understand. Do they need to switch from using diesel to gas? But then there's also the problem, the discussion about gas production in Nigeria. Do we think that we are at a point in Nigeria where the gas, that is being produced, by the country can fulfill the demand if all of us business owners here decide to switch? Are we at the point where we can fulfill that, demand? I would like you to speak on that, and if you have anything to add to that too, you can.
I think it's a catch-22 situation. We have over 200 TCF of gas. We're basically selling quite a bit of gas through Nigeria LNG today. We're making a lot of money off that. And people complain, why are we selling gas when we have gas? I think we have enough that can go around. The problem with the domestic market has always been around building the demand first. Because gas, in a way, is almost like power also. You cannot build gas infrastructure until you know where the demand is. You have to sign those contracts before you sign. You sign those contracts, make them bankable, use that to secure your financing, and then before you can then take FID on a 100, 2, 3, 400 million dollar project to lay pipelines or take FID on an LNG infrastructure or whatever it is you have in that ecosystem. So the bulk of what we've had, what we've benefited from in Nigeria in the last 20 something years, 20, 30 years has really been around infrastructure that was built by the people that came before us. The Escravos Lagos pipeline system was built by the Babangida administration. That was probably when I was in secondary school or primary school or whatever. You know, the Obi line has been built since Dezani was Minister of Petroleum. Dezani's left now, going on almost 12 years as Minister of Petroleum. You know, we've not been able to connect all of these bits of pieces that can then connect other parts of the country. And then, of course, the bulk of the work around the pricing system, I think we're not where we were. You know, I joined this industry about 22 years ago. We're not where we were in 2004. We're not where we were in 2008 when the gas master plan and all those things were being put together. We have investments in CNG. I did the first CNG play in 2009. We have at least 20 something CNG players in Nigeria today. We have at least 2 to 3 mini LNG plants by the end of 2028, which we have at least 7 mini LNG plants operational today. From the government, we've had at least $200 million invested in the CNG play. So I think we've done a lot around the demand, generating that demand. But I think we are going to get to a point where we need to take firm decisions to ensure we don't have a overhang in terms of supply. So I think that's where we need to do a lot of work. Make sure those infrastructures get built. Make sure we encourage that investment from the upstream operators. Make sure the pipelines that connect the upstream to the demand centers are done. And then remove all the plays for people playing tricks. This is Nigeria. People will always want to make more money in funny ways, and then ensure that then engenders investment in the ecosystem. But we're not where we were. You know, total demand in gas domestically, removing the power plants, because power plants as government, that's always there. It's been at least fourfold in the last 15, 18 years. So we've gone a long way. But the problem is, if you are starting from zero, you know, even if you get to 4 years, you're supposed to be 20. You know, 0 to 4, it looks like a good thing, but you're supposed to be at 20. Yeah.
Do you want to add to that?
Okay, I think my addition to that is said a lot of it would be the commercials also have to make sense. So yes, we have to build the infrastructure, but again, when you think about our production capacity today from a gas perspective, we definitely need to produce more for exports and for domestic market. Now, the incentive for any producer today, so if I start producing today, if I had a well and I'm producing gas today, my first preference is to export. Do you know why? Because there is sanctity of contract, right? The commercials make sense, right? In the domestic market, the visibility around that is not really clear. So we need to look into the pricing. We need to ensure that as people are making investments all the way down the value chain from the producers and in the upstream all the way to downstream where the retailing is happening, there's a lot of investment that needs to happen, right? Then the commercials for all of that needs to be transparent and clear to everyone, and one that delivers value to investors, right? If I also touch on my point around the electricity market being nascent, right, very quickly. So, I mean, he came here and said we should all thank Dangote. That's good context, right? So when you think about the electricity market, the difference between the electricity market and the, should I say, fuel market, right, where you think about energy, is we have an option there where we could import. So imagine the world where we couldn't import petroleum products and we had to rely on our own refineries, right? The same insufficiency of supply that you see in the electricity market today is what you will see in that market. There will be scarcity, right, and to be very expensive. So now getting players like Dangote coming into the market, building the refinery, that's the same thing that needs to happen in the electricity market. Like we need to have the private players come in, do make those investments and be sure of their returns.
It's interesting that you're pausing at private players, because my next line of questioning was going to be on I mean, again, referring to my former life. I used to write reports about this company that it was an FMCG company that at some point started their own power plants to cut out those issues with production. So we've had, it seems like companies are beginning to think like that. How far do you think we've gone? Does regulation, does the I mean, there's still a bit of regulation around electricity, electricity generation, distribution, the whole value chain in Nigeria. We've gone from phases where you had the federal government to state government, private. So how supportive, one, is the regulation in that? How far do you think companies, what factors do companies need to put in place to be able to get themselves to a point where they can then privatize their own electricity generation, and probably even supply to the domestic markets for themselves too?
So I think the I'll start by saying that there is, again, it's evolving. So one of the things you'll see in the market today is we used to have a scenario where um, electricity was on the exclusive list, right? It was regulated by NEC, right? We've seen a new electricity act that now says states can start looking at their own electricity regulation and figuring out how to deliver reliable electricity to consumers. Now, what does that mean? It means that we're shifting from that federal perspective where you're trying to solve the big Nigerian problem, right? So, okay, let's put this problem in pockets and start figuring out how to solve them. I think what also needs to happen is the states also need to start learning from that and start saying, okay, how do we create pockets of solutions, clusters of solution, and say, how do we also leverage the private sector? The federal government started doing that. Next started issuing licenses to private participants. If you wanted to solve your own power problems, the big players like Olam, for instance, would have their own captive power plant license where they're doing more than 1 megawatt, right? That needs to happen at the state level too. State also, I think, perhaps some gold mine is, and I think some states are already thinking in that direction, is how do we aggregate excess capacity that certain companies, the Nestle, the Olam, FMCGs have, right? And how do we see how we can aggregate that and distribute to consumers and just plug in the distribution infrastructure that allows for that and have the right commercials that back that up, right? Those are some of the things that we need to look at going forward, right? I think it's a better market now because there is now room for more private participation. Um, and again, like I'll say, I think it's evolving is not set.
I think so just to, also get your perspective on collection rates. Because you mentioned metering when you were talking about when you're giving your first answer, and the fact that that has been one thing where, you have private individuals, states, federal government. So far, there's been an issue of, yes, generating, we are distributing, but then how good is the collection? You don't have a lot of discos that are able to, ramp up a lot of collection for their revenue, like when they distribute to the domestic market. So how effective then? My what I'm thinking about is, if we have private individuals coming into this space, there's the risk of collection. But do you think that private individuals are going to have better is it better results? Is that the word I want to use? Better luck with improved collection? Yes. Do you think that's possible?
Yes, I think so. I I mean, at the where I work, right, we provide power supply to um, private users, right, and I'll say that our connection, not of 90, maybe 98% and above, right. You may have some delayed receivables, but more than that, you get to people respect the contract, so you get your collections. Um, I think in Lagos, it's different, right? I mean, the two best performing discos are also in Lagos, right? Because again, we know why Lagos is Lagos, right? Collections really is one of the things that we need to look at and develop strong solutions for as we go on, right? And I think it starts from understanding what our real cost is, right? Again, I always start from if the commercials are right, everything falls in place, right? So to the extent that we understand the constraints around investment today. So if you think about all the discos today who have underperformed, right, and I don't want to speak about their numbers, right? One of the things you'll see is one, they struggle with collections, and because they struggle with collections, they are unable to invite investment, right? And the so there is a market shortfall. There is also a tariff shortfall. Right now, the tariff is not properly priced in the way that across the value chain, every player, so from the from TCN, sorry, rather from the gas providers to the Gencos to TCN, everyone across the value chain getting the right, ensuring that our tariffs are cost reflective, right? That has not been the case. And if that's not the case, and someone is saying, I'm going to be the one to fill in the gap, right? If you are also filling in the gap and you're delaying and you're not meeting your obligations as the person who is filling in the gap, then you create the crisis in the market, right? So people are not earning enough to make additional investments. So everyone is just doing enough to keep the status quo, right? What I think the market is doing now is figuring out how to participate, how to engage, how to do collaborate and do things better. So company like ours, we're doing certain things with even the discos and figuring out how do we come in with our own private investment and see how we can, on cluster basis, improve collections, improve supply, embedded solution, grid supply, and create a better and more reliable solution. So that would happen. More of that will happen.
So for any company thinking of, what are the bottlenecks that you'd have with your own power plants, it's possible. I mean, 98% collection rate is very good. My eyes widened when you mentioned that. So I want to put you a bit on the spot, Mr. Falabi. We know one thing I think I mentioned at the beginning is how dependent the Nigerian, especially for FX, is on it. And then with the alternative sources of energy that are coming up, everybody's talking about focus on gas, focus on CNG, focus on solar, focus on. Do you think we're ever going to get a point globally and in the Nigerian economy where crude oil is no longer, it now becomes a secondary source of energy? Do you think we're ever going to, is it a realistic thing to, expect?
Not in your lifetime. That's not. I think this I like to be frank when I'm here. Please don't tell my organs in jail. But I like to be. I think what Hormuz has shown everybody is that this hoity-toity, renewable, all this, whatever is. No. At the end of the day, a lot of things are dependent on crude oil. At the end of the day, half of the clothes we're wearing have crude oil in them in some shape or form. Your drugs have crude oil in them. Your fertilizer has oil-related stuff in it. Your shoes have. There are all sorts of things that are tied to it. So it is what it is. What is happening, to be truthful, is that oil and gas share is dropping. It's clear, but you will not get to zero in your lifetime. And even within that drop, gas's share is actually increasing because of the benefits of gas. So it's much cleaner. You can densify it and get all sorts of things. So yeah, it's more amenable to power generation in certain ways. So all of that is clear, but definitely not in your lifetime. And I can also not in our lifetime because I'm not going to be 200 years old. But the other thing again that comes out of it is around that forex issue again for Nigeria is that we've been running on one spot for a long time. Now, when I got to my current house, I think power I live in a poor man's area anyway, but power was like 15 naira per kilowatt hour. 15 naira per kilowatt hour was about 12 cents back then. That 12 cents, your 209 naira band is about 13, 14 cents today. So in dollar terms, we've not moved in the last, I don't know, 14, 15 years. So what has happened really that has made a lot of the things that we want to do in the power space really challenging is that the average Nigerian, unless you have made oil money or you've done Yahoo or you are in government or whatever, is 10 times poorer. Has become anything between 6 to 10 times poorer the last 12, 15 years. So it has become extremely challenging to create a system where you can then increase the prices based on how far the naira has gone over the last 12, 15 years. And that's why we have a lot of the overhang we're having now. So it's going to be around government now having to sit down to say, what can they do? Number one thing is going to be you have to stop dropping. So luckily we've had the last 1 or 2 years, exchange rate is stable. People like Ola, people like Nestle, can stop declaring losses, can start making money. Which we're seeing, Nigerian boys is selling more, everybody's making money, NGX is looking good. So that stability has created that. So it's now going to be how do we then translate that stability into better wealth? Because it's a macro. At the end of the day, power is everybody. You can do all this stuff, but if your customers are include the 80 something million that are bottom of the pyramid in the country, I want to sell power to them, you have to include them. And that's really where we are. So you've stabilized. The thing is going to be to increase the wealth of the average Nigerian. And then once you then do that, you then have a basis for actually charging people 300 naira, 250 naira per kilowatt hour, which they can then afford to pay. Until you do that, the people that can afford it will either pay or develop their own power. Power for an average manufacturing company is anything between 30 to 55% of your total costs. My bill for gas is the biggest cost item. You get me? For a lot of the companies I supply gas to. So it's not a joke for you. So you can't afford to sit down with people who are joking and putting on lights up and down. So it's a major thing. So people who can, and that's the problem we also have with the grid, because the people who can afford it or who have shareholders to attend to will just go. They can't afford, they can't sit down. And so you are now left with the poor people who can't afford to pay. So there's a lot of work around beyond just all these things around collections, which is good. There was like 40 something, is now about 90 something, fantastic. But if you are collecting what less than what is costing you to bring the power, you're still not getting there. So I think it's a which is why I don't like to discuss it between you and I. Because everybody that wants to go to power thinks it's an easy thing. Once they enter, it becomes a problem. And it's a 20-year project. And the average president does only 8 years. So it's what it is.
Okay. I mean, I like the fact that you mentioned NGX before. For investors like, well, the bigger investors are there, but for retail investors like me and then institutional players, we are also excited about the fact that there's been that stability that you mentioned with the oil production, with the FX, Nigeria, and then that has translated. So I would like you to then do a bit of a walk back now. What do you think the future for that oil production and FX market should look like? Because then it also impacts what we are going to be getting from the NGX in the next 2 years. So what do you think the next 2, 3, 5 years would look like for Nigeria?
Okay, I think first thing to say is I'm not speaking for Shell. Please don't get me sacked. But as Afolabi and Kirogode, my thoughts are that we're going into a period of volatility for the next 2, 3, 4 years. That volatility will probably make oil move from anything between 50 to 90 over the next 3, 4 years. That's my personal view. So, which on the whole, on the balance, is good for the Nigerian federal government because you're making more money. The other benefit we have for anybody who is doing macro planning is this is probably the best government in the last 20 years, probably since Obasanjo left government, that has been positive towards the oil and gas sector. Because if you look at the whole raft, you're an analyst, the whole raft of executive orders, of laws passed, of things done, Shell has done at least $6-7 billion of FID. I just got off a project meeting before coming here. I've been looking for operational readiness expert for like 6 months now. I can't find because I can't afford, because everybody is off. You are either in a Gina, you're on Bonga, you're everywhere. I can't find anybody to do that work there. So there's some rules that because the industry is booming. The industry, because it's become clear to the president that, I can make money by this sector. If this sector booms, then I can make money in dollars and I can solve my other Nigerian problems. So you have the best, probably the best government in terms of oil and gas sector overall, upstream, downstream. But upstream, the upstream is the best government we've seen. So everybody is coming to Nigeria. Everybody is seeing the president is making things happen for them. I expect another $4 or $5 billion of FIT in the next year or two. So that is very, very good. If that happens, then you can expect Aradel, Seplat, everybody to combined also with the fact that prices will not drop, also to continue to do better. The only thing would then be around, what this means for the larger sector, what this means for Dangote, because if you are producing oil and you have to then manage your own domestic use, how do you manage that balance between your domestic needs and what you have to export?
Well, I mean, I think some of us are very excited to hear that. But then just still, going back again to, yes, we are seeing better performance on the oil sector, but for the electricity market, yes, it's improved in some places where we now have a few people on the more. I don't think it's still the best tariff, I mean cost effective tariff yet, but probably better on some people on band A or some other bands. And if you're in band A, wave your hands, please. Okay. So I want to ask for those of us that always, we're always looking at electricity generation in Nigeria. If you go on Twitter, any 3 business days, oh, national grid has fallen. What exactly is the solution to that constant that problem constantly coming up? The fact that, oh, you have blackouts today because there's a national grid problem here, so what exactly can Nigeria do to resolve that, maybe improve that situation across the country?
Okay. That sounds more like a technical question. I will try.
Okay.
I think one of it is, again, a lot of the moves that we're having right now. So if a state like the Lagos state, for instance, figures out its own grid, right, and figures out its own spinning reserve, right, redundancy and all of those things, maybe perhaps also have a philosophy of an N+1 for its grid, right? If the national grid fails, Lagos State has a shocker that puts power in and maintains the grid, right? I think those are the things that we need to do. So I think that a lot of the solution that we need to be thinking looking forward in the electricity space have to be decentralized, right? The moment we're still thinking about trying to solve everything from an holistic view, we're going to be running a rat race, right? That's my view. So things have to come down to how do you decentralize it? And so the point on pricing, right? I like what Afolabi said, right? That we haven't moved much, but I think that's also a testament to the fact that we're resilient as a market, right? So if you take the US market, for instance, as a benchmark, the cost of electricity on average in the US is about 15 cents, right? Our band A tariff today, like you rightly said, is around 14 cents, right? So there's still we're still matching with international standard as much as possible, albeit we think it can be optimized. We think that it can even go down. Why? Because again, one of the things that is also mentioned, we're blessed. We have natural gas, about 200 trillion cubic feet, yeah, TCF, right, of gas, right? Domestic gas can be transparent, can be cheaper. If the input gas is cheaper, like you rightly said, right, it's about 50 to 60%, especially for power generation of your cost, right? So if you bring that down and there's transparency across the value chain, everyone knows, hey, this is the price of gas anywhere for the domestic market. Not that some people are enjoying cheaper gas, some people are enjoying more expensive gas, and there is disparity in pricing across the market. Then it's going to be very hard to holistically solve that problem, right? So I think there needs to be, clear visibility into the pricing structure on the gas market. I think that our solutions going forward have to be decentralized. The power system is sensitive, so I'll give you a good example, right? If anything happens in Kano, for instance, if there is a significant damage to maybe a TCN station in Kano, if that size is substantial enough to shut down the entire national grid, it goes down, right? So the way to stall that is, first you have to find a way to isolate that in some way. So you have protective systems, you have redundancy across all the states. So it really falls back to that. And again, all of this it lands on Naira and Kobo, right? The commercials have to make sense.
It sounds very capital intensive.
Oh, energy is capital
Exactly.
intensive.
So for people like us that are going to be, looking for better, I think all we can, we're at the point where we need to, I don't want to use the word hope, but just expect that there's some form, by some wave of some magic wand, the capital becomes available to be invested in these places, by both the federal, the states, and private citizens that then can help to improve the generation. I think one last thing I would like to ask, you also mentioned, during well, I think when you were giving your first or second answer, I'm not sure which, you said that there are solutions that companies need to start putting in place to be able to improve their collection, and there's some things that you're doing in house in your firm too. So do you mind? Are there trade secrets, or are there things that we can learn a bit from, in the volatility that is being experienced in Nigerian energy market?
So, I think the core difference between what we do and what you'll find the discos do is a lot of our services are backed by contracts, right? So you have a power purchase contract, a service contract, and all of those things. And so there's sanctity of contract. So people would find a way to meet those obligations. And our value proposition always starts from, if we're not improving your cost of generation of electricity or energy generally, we shouldn't be talking to you. If you're already doing it better, then there's no point. So more than likely, every time we're speaking to someone or we're delivering a solution to a customer, you realize that they're more eager because you're already showing them cost savings. And someone who already is willing today, a good example, someone who is willing today to burn diesel 24/7 to ensure reliable electricity supply and is buying diesel at say 1.8 per liter, right? And you say, hey, I have an alternative for you, which is gas, right? Let's figure out this works, the construct, we make the investment, and all of those things. And from a gas to diesel perspective, right? And I know Afolabi would know the numbers better, but from from the units of energy you can get from them, it's slightly similar, right? For every for every liter of diesel, you should be able to get roughly about 3.55 kilowatt of electricity. Gas is almost close to that. I think it's 3.54 or something, right? So effectively, you can do the numbers almost from an approximate base and say, if diesel is 1.8, right, and what do you call it? Gas is roughly today maybe 500 for an average in the market. You already see the cost savings between 1.8 and 500, because both of them will generate almost the same volume of electricity. So once you have that, I think people are more willing to, participate. And yeah, but I would just say, from a commercial point of view, I think it's the contracts, right? And from a retail perspective, it has to be technology, right? The metering systems have to be theft-proof. There has to be, at every point in time, you have to have nodal points where you can tell, almost like think of it as similar to an exchange. Every time you put power into something, you have to be able to see at every point in time where it is. So SCADA solutions have to be in place where you have full visibility on the entire supply chain. Yeah.
Thank you very much. And your last question, Mr. Falabi, for companies, what we've been discussing, how can companies protect themselves, alternative sources of energy, gas, and and as you mentioned, at the commodities market, energy markets for the next 2-3 years, you expect it to be volatile. How do you think, for companies that are not able to pivot, they're not able to pivot to gas, they're not able to pivot to CNG, they're not able to make any moves, they have to work with what's on ground, the status quo. How do they still protect themselves in the volatility that we're expecting in the markets?
Like you said, everything energy or power is money. So I think, well, there are quite a few more models you can also look at. You can talk to companies. I think I've done gas, I've done oil, I've done renewables. I was CIO at Olon, which is Shell's renewable energy investment platform. So some of the companies which we invested in back in the day were companies which had power as a service models, where you basically just almost like a PPA sort of like, but you don't have the burden of paying the capex for a whole power infrastructure. So Daystar, which is also a company which Shell owns, which operates in the solar space, serves C&I customers, commercial and industrial customers. So we have companies in that space, commercial and industrial, and also homes or small businesses that gives you power as a service contracts where you can then basically just pay for what you use or pay based on a take or pay minimum usage contract basis. So that removes, so to speak, the cost of you spending 50 million, 100, 200 million on that infrastructure. So that is still cost competitive compared with diesel. Of course, what I was talking about in terms of the cost competitiveness, for gas, you would have anything between 8 and 13,000 naira per MMBTU. That's the unit cost for energy for gas. For diesel is about 45,000. So if you look at between 8 and 15, compared with 45,000 naira for the same unit of energy, that shows you the cost competitiveness of gas. So, and then the other thing which we touched on, which is also critical, even for the companies which are operating within the larger companies, the Olams, the Nestle's, the Dangotes, any companies operating in that ecosystem, is going to be around moving your mind away from a just-in-time system. The just-in-time system, given the volatile VUCA world we are in right now, is not going to work anymore. So you need to find a way to stabilize your base. Even if you're going to play games and optimize on your systems in terms of pricing, decide what is my base supply. Is that base supply assured? Am I happy to lose a 2-3% or pay a 2-3% premium to have that base assured? Because if I'm a supply chain manager and I want to show that I've saved 250 million for my company this year, and something happens, government policy changes, something happens in the supply chain system, and that system disappears because you didn't have that full optionality, then of course you're going to lose your job or something else is going to happen to you. So those are the things we have to begin to look at. How do I do security of supply? And then how do I then optimize on top of that? So those are the things which companies need to start building going forward.
All right. Thank you very much to my wonderful panelists. I think I really enjoyed the conversation today. And thank you to our audience for being with us. Do we have any questions from the house?
Questions from the house?
Thank you very much. I think while Mr. Yusuf was talking that Meristem have to be doing this program every year, I think I know the reason now. This is actually my first time coming as well, and I'm definitely blown about what I'm seeing. So thank you, Meristem, for this opportunity. So, so I think my leisure time, I have to focus more on energy consumption. Like I have to learn more about energy because it's like at some point I got lost that what are you even talking about? But my question is that majorly for all industry, they are all capital intensive. So majorly I'm in agricultural field. So part of our major challenges is what's on energy. So like, and based on what the panelists said, if you can't afford major rely on NEPA, like we know, what are the options that we can actually rely on? Because we've seen farms in rural area that they majorly like rely on this thing, petrol. And we know the current cost of petrol and how those things actually burn faster these days. So I had someone, and also they bought a petrol of 12,000 naira, and it doesn't even last within 3 days for just 2 hours. So that kind of thing, we're actually spending more just to get little. And that aspect is actually what costing us more. So for someone in the energy field, what are the other alternatives? Because definitely there's always the bigger players and those were like the middleweights and the smaller players. So what are the options that people can actually like bank on before they get to that bigger options? So I think you get my question. Thank you.
Before feedbacks are taken, I'm just going to write on that question from an audience online, which says the conversation in the energy sphere has been much on institutional, industry, and household use. how do we devolve the focus on renewable for farm sites used to scale productivity and improve the value chain across board? For instance, in irrigation, post-harvest handling, and small-scale processing.
Okay, maybe I can take because of my old, let me brush up on my renewable energy. But I think the way it is right now is renewables has become so wide, and there are applications. Luckily, because some of the best use cases you even have right now, which is why you see there are a lot of DFIs, a lot of foundations, a lot of global capital impact investors in that ecosystem looking directly at use cases for the bottom of the pyramid for of course the bulk of the Nigerian population. So you have systems like solar home systems, which are like small systems, which Sun King, for example, which is one of the largest companies operating in this space, which basically have systems which you can then use to charge a phone, a laptop, whatever that can be enough for your house. Those are anything going from anything from 200 to 600,000. I got one for a second cottage for 400,000 earlier this year, and she's told me it's made a difference in her business because that means she can charge it throughout the day, and then between 4 p.m. when the sun starts going down and 9 p.m. when she closes her business, she can use that, and that's just about 500 watts to put on the lights, let customers come in, attend to them, use the fans, put on the TV, have the radio on, and that's okay from between 4 and 6. So there are all sorts of mode. And then in the daytime, if there's no light, it also serves and also continues to work. So you also have things like energy mobility. You have, I'm sure you've seen a lot of these bikes that move around, which are powered using batteries. There are all sorts of companies which have those models in place right now. So there are other, because your needs are really small at that level. You know, the average Nigerian home may not use more than 5-6 watts, 5-6 kilowatts a day. That's not much. So you can have systems that can be for that. And then you also have companies in the ecosystem which are also financing the acquisition either on the lease to own basis or as a pay as you use basis for some of these products. So these are also available in the ecosystem which people can then look at. The best people who benefit from this usually are people who have what they call productive uses, because if you are using that solar, however small it is, to make money, whether you're a hairdresser, you're a tailor, you're a barber, you are more incentivized to pay and to keep it used because you can quickly compare it with the cost of using generator. And then you can say this is obviously a good deal for me. If you are somebody who is living in your house, usually if Nigeria happens to you, you think, oh boy, let me leave this thing, let me pay my children's school fees first. But that's been the trend they see generally in terms of uptake in that area.
All right. Thank you.
Okay. No, so I think your response sort of responded to both. So for all the questions online, we're happy to take them. Okay, in 1 minute, I'm going to take this so we move swiftly.
Hello, I'm Emmanuel from Wilma. We deal in the oil palm sector. So I wanted to check, like for us, we have around 30,000 hectares in Cross River, where we are working on a project for methane capturing from the effluent wastewater. How can we integrate into the energy system? Like when we are running at full capacity, we will generate more electricity than we'll be consuming. To help the local rural communities around, how can we integrate into the Nigerian system to at least within our own space solve the electricity challenges within the rural area? So how can we integrate into the energy sector and the full electrical system for rural areas in Nigeria? Yeah,
Thank you. Feedbacks?
Okay. I was just whispering to her that requires consulting. But yes, I think there are ways to do that. First, if you're in Cross River State, and they're already set up their state's regulatory commission, right? I think the conversations can start from there to say, hey, we have excess capacity we can put on the grid, right? Of course, a few things will happen engineering wise, right? I won't bore you with that, but I think that's the starting point. You get the requisite licenses to be able to sell power to the grid. More than likely, it might be useful for you to do your own business development work to find where you want to sell the power to the clusters, right? If you're really concerned about returns and collections, right, more than likely you want to also ensure that you have your own contracts that back all the investments you're going to be making to be able to push power to the grid, right? If this is CSR for you, very good, right? All you need to do is to tell them, I have this power, where can I dump it to you? And they'll figure it out. But if you're going into business, right, then I think you need to find those contracts.
I think one thing I really learned today is the power of the contracts.
Oh, yes,
Because yeah.
very important.
I think he wants to add more context.
Yeah. If there's the thing with the regulations, if we can give us maybe a tax incentive or something where we give the electricity, we can create the amenities. But just an incentive where we don't have to deal with the nitty-gritty of paying for power. And
I think one of the best things you can do is to really define how much power we're talking about here. You get me? If it's how much power, how regular it is, what is the scope of what you're talking about here? If it's going to be like, if it's assured, if it's going to be like a megawatt or two, will not be too much work because you can then engage people like the Rural Electrification Agency. They tie you into one of the maybe mini grid companies which they have in the ecosystem. You then become the upstream supplier to that mini grid company. And there are quite a number of mini grid companies operating in Nigeria. I think invested about $20 million in a couple of them back in the day. So connect with those companies. Those companies can sort out their bread and butter to sort out all of those things around regulations and what have you. And then you solve the problem of the energy supply for them. Because I've always been looking for renewable energy opportunities to invest in, but your own area, but I can't find because it's been difficult to find enough power to be generated from that source. So I think you have a unique situation. Connect with one of those companies. They will solve that problem. It can even be his own company. But as long as the community can pay for the power because it's not doing this to be doing well. But those mini grid companies know how to access grants. They can access the DES program from the World Bank. They can access all sorts of things that can balance it up and make it business model that works for them.
All right. Thank you very much. And I think it will be good for you to consider the Meristem Capital and Meristem ecosystem when you're considering this setup. We're happy to work with you. Thank you very much for this session. We'll take photos now while we move to the next phase. Photos for panelists and moderator. And it will be good to mention that at this point, we have 100% participants from everybody who has registered for this event. I think this is worthy of a round of applause. It shows the Meristem team is thinking in the right direction. We have people ready to consume what we are developing for the market. Thank you all very much. Swiftly, so as not to take your time, we would move into the commodities fund launch. And to do us the honors is the treasurer, Meristem Wealth Management Limited, Okemute Sagwa, for this session. Round of applause for her. Thank you very much. Boss lady, you see.
Thank you very much, Babatunde. Good afternoon, ladies and gentlemen. And I'm very honored to be carrying out the task we've all been waiting for, at least I have been waiting for. We've been working on this fund now for over a year. Yeah, going on 2 years. And I'm so happy that we're finally here. We're live in the market. Over time, we're used to this market, we're used to traditional assets, of course, money market, fixed income, equities, and the likes. And you always have investors asking, what other alternatives can you provide for us? What options? Meristem, you've been here. And so you asked, we listened. So we're here to present the Meristem Commodities Fund. Can we have the features of the fund on the screen, please? Do we have it? Or should I just go ahead? I should just go ahead. All right. So the Meristem Commodities Fund is a SEC registered fund and approved. And basically, it's to, like I said, offer our investors opportunities into the commodities market, structured, regulated, investment grade opportunities into the commodities market. The fund manager is Meristem Wealth Management, a seasoned fund manager in the market, a subsidiary of Meristem Securities Limited. The fund size is 5 billion naira to start with. It's an open-ended fund, so the idea is for the fund to continue to grow over the years. So in the first instance, we'll be launching offering 5 billion naira, which is about 100 naira per unit. It's the first institutional grade commodity fund of its kind in Nigeria, a proper investment vehicle. Thank you. A proper investment vehicle for the commodities market, and the commodities market is maturing now. In the commodities ecosystem is maturing now. So we are happy to be one of those, pioneering this kind of structured fund in markets. Some other funds exist, obviously, but none like ours. What are the benefits of the fund? Number one, I would say is strong returns. Okay, the slides are on now. In my subsequent slides, you will see, I'll show you the performance of the market, but strong returns from that space, our investors will finally be able to participate in that market. Liquidity, diversification, that cannot be overemphasized, and then protection against inflation and exchange rate volatilities. Because when Yusuf was presenting, he was explaining the link between the exchange rates and the commodities market, as well as inflation and all of that. So with such a fund, you'll be able to protect your portfolio better against adverse movements in those macro indices. Liquidity, because of course the market is liquid and the fund is being managed by professionals. So we would manage the fund in a way that if you need your money, subject to the terms of the fund, you can always have access to it. Going on to the next slide, the fund at a glance, I already said is a specialized open-ended CIS, which is a collective investment scheme. Size is 5 billion. Number of units, 50,000 units at 100 naira each. Minimum investment is 5 million naira because the fund is targeted at qualified institutional and private investors. And then commencement date was actually 18th of May, but today is the official launch of the fund. Then for distribution, that's income distribution, 75% of the income would be distributed annually, while 25% will be reinvested in the fund. Now for liquidity, I said earlier that if you need access to your funds, you have 5 business days basically, and that's knowing the nature of that market. It's not like money market that you just liquidate today and you get it today. So there's a 5 business days and there's a 90-day minimum holding period. The trustees and the custodians to the fund, we have Codrus trustees as the trustees to the fund, and RMB, which is Rand Merchant Bank, as the custodian to the fund. This just shows you the structure of the fund. There's another slide that's going to also speak to that, all the parties to the fund. And then for early redemption, if you're taking your funds before the minimum holding period, there's a fee of 20% of the accrued interest. So even though there's a minimum holding period of 90 days, you can still have access to your funds just at a small fee. The next slide is on commodities. What kind of commodities the fund actually invests in? Well, so we're looking at physical commodities, like all we've spoken to today, agricultural commodities, solid minerals, energy, and the likes. Commodity-linked equities, stocks of companies that are into commodities, the likes of Presco, Como, Aradel, in the energy sector, and we know the performance of those companies over the last, should I say, 5 years. Then securitized commodities like ETFs, features, options, and the likes, of course, on the ones on approved exchanges, and then commodity-linked money market instruments like CPs or debt notes from companies that are into commodities. For the governance and the other parties to the fund, like I said earlier, I mentioned who the trustee, I've mentioned who the fund manager is, which is Meristem Wealth Management. Codros trustees are the trustees on the fund. Their job is to provide fiduciary oversight, ensure that the fund manager complies with all the laid down rules in the trust deed. Then we have the custodian, which is Rand Merchant Bank, there to ensure safekeeping of all the assets and proper reporting. What we report is in line with what they have in custody. Then Creston Pedabo are the accountants to the fund, and then DLHQ are the legal partners to the fund. So we can see that this is a very structured fund in line with SEC rules. And then who can invest in this fund? Of course, QIs, qualified investors, family offices, corporate treasuries, PFAs, trustees, in anybody really, as long as you understand the type of fund you're investing in and you have up to the minimum required amount. Then how do we measure ourselves? This speaks to the benchmark for which the fund is going to be measured. Considering the kind of commodities we're investing in, it's a blend, right? It's not just one index or that can give us what to measure the fund with. So 50% will be benchmarked against the FX Commodities Index, 20% against the NGX Commodities Index. That's a total of 70% in commodities. And then 20% against the DGCX, the spot gold index, and then 364 days treasury bills yield 10%. So very little of the fund will be in cash or near cash assets. So most of the funds will be in commodities or commodities linked products or assets rather, and then very little in cash. So you can see the mix of assets that the fund will be invested in and how it's going to be measured. Now, we did a back testing of the performance of the fund, if it had been in existence anyway, using the asset allocation of the fund that we have now. And we back tested for 5 years. It's not opening. Yeah. So we can, I don't know if it was showing on screen. Yes, great. So we can see from 2021 till date, the first one there is the Meristem Commodities Index average return, NTB yield plus a risk premium, I think, of 5%, and then equities return, and then the weighted average across all those sectors. So if we had the fund in 2021, it would have been around 50% weighted average. Weighted return rather. 2022 about 12.64%, 2023 62.57%, 2024 68.81%, 2025 rather challenging year 1.39%, and then overall 5-year average about 39.15, almost 40%. So we can see that there's a lot of opportunity in this space, and with the right manager managing your fund and with the expertise that Meristem has displayed here today, with everything that we've put in, we believe that this fund is going to perform very well, and we would like to have all the investors in the room participate in the fund. So thank you. We invite you to subscribe. Scan the link. The fund will be open from now till end of July. And then we'll do the allocation and advise investors accordingly. So this is the offer period. Thank you. We're open to questions.
Okemute Sago as well. I think you shouldn't sit. Move to the next table. And Managing Director, Codros Trustees. Money. I'll advise you come to the stage while I call on the Group Managing Director, Meristem Securities Limited, and the DGMD to join them on stage. Also present is you can hold it. Also present is the MD Meristem Stockbrokers Limited, MD Meristem Family Office, Fumi Adekola Daramola. Please let's join them on the stage for photos. Thank you very much. A round of applause for the team. So as not to take your time, because I know we've spent a lot of time today. So I'll call on the Deputy Group Managing Director, Meristem Securities Limited, for closing remarks. Mubo Olashoko to the stage, please. Round of applause for Mama.
Wow, wow, wow. Good afternoon, ladies and gentlemen. We want to thank you for the valuable time that you have spent here with us this afternoon, and we don't take it for granted. And we're not just thanking those who are here physically, we're also thanking those who are there online, that have joined in this discussion this afternoon. As we round up this very insightful summit, I want to believe that we all, have we've received fresh perspectives. We have made valuable valuable connections here, and we have also received practical insights, that we can use, in our various work. We do know that we have very significant, enormous opportunity in Nigeria because Nigeria is endowed with natural resources, agriculture, mineral resources, and all of that. And with discipline, with the right structures put in place, with market discipline and all of that, we believe that we can build a commodities market, that will benefit, create wealth for people, bring about national development. And as we live here today, I don't want us to see it as the ending of this discussion. I want us to see it as the beginning of deeper engagements that can bring about solutions that will help us, to build our economy. Our economy should not be dependent on what happens, the global economy. Rather, we should be able to shape, what happens to us, what happens to our market. So I look forward to us discussing more even on this. And I wish you, safe journey back to your respective locations. Thank you very much for coming.
Thank you very much, Mubo. And on this note, I say subscribe, subscribe, and keep subscribing. Thank you all. Good afternoon.